Okay, so we have discussed this, looked at this chart before. So we are saying Q is the announced accuracy and P is the expert's competency, and we have said that it increases linearly with expert's competency, and then a certain point comes when announced accuracy becomes one. So we'll look into the details of the model a little further. So over here, we start from by thinking that the market actually believes or it guesses that the announced accuracy is a function f on p, where p is the expert's competency. So we are saying that announced accuracy is a function of p. In our graph case, we have assumed that's a linear one. So when p is between 0.5 and p star, it's a linear function, which is in this case fp, and announced accuracy is 1 when p is greater than p star. We have actually seen that in a graph too. So we can see it's a function fp over here when it's p is less than 0.5 and p star. When it's greater than p star, it's 1. Okay, so now market takes the information and actually tries to find out what this, tries to find out the expectation of experts' competency. So announced accuracy Q is between 0.5 and P star. So if market sees that, okay, announced accuracy is between 0.5 and P star, then it expects experts competency M to be inverse of that function FQ. Now Q, because Q is itself is a function of P, so we'll come back to later. Announced accuracy Q is between P star and 1. So if the market sees that it's in the upper end, then it expects experts competency to be 1 plus P star divided by 2. Okay, and M is the market expectation of experts competency. So going back to the experts payoff, so we now calculate the experts payoff in both these cases. So in the case where the expert announces with accuracy 1, where Q is equal to 1, we use the payoff that we have. We use B, where we have determined the expert's expectation of expert's competency. So we use it over here in place of M, and we get expert's payoff, where we get x times 1 plus p, which is p star divided by 2, 1 minus p, and Q is equal to 1, so 1 minus 0.5. Now if he announces with accuracy fp star, then Q is equal to fp, and then using A again as before, M is equal to inverse of this, which turns out to be P star itself, and then again plugging the values into the expert's payoff formula, we get this value, we get this equation. Okay, so now we have got two different payoffs. We have got payoffs for 1 and for P star. So since market believes announced accuracy to be 1 if P is greater than or equal to P star, then the expert is indifferent between the two payoffs. So because we have calculated the payoffs when announced accuracy is 1, and also the payoff when announced accuracy is P star, and in terms of the market believes that both are equal to same, so that means the payoff should be the same as well. So we equate these formulas, or sorry, these two equations to find P star. And this is a derivation that I have done. It's in PDF. So it's simply it's there to calculate P star, which we see as a function, an inverse function of 1 minus x divided by 2, where x is the scaling factor for M, if you recall. Okay. So if we announce it with accuracy fp and not fp star like previously, so we now take it to be p, which is between 0.5 and p star, Q is equal to fp, and where p is less than p star, then using A again, which is inverse of fq, we get the expert payoff as this. So we find the first order and second order conditions. Again, the derivation is shown as the next page. So the payoff is this. The front order condition we get as this, and the second order condition we get as this. So we use a property which is the derivative of inverse function is the reciprocal of the derivative of original function. We use this property to actually come to what the function fp actually means. Fp meaning fp is a function of p, and which if you recall correctly, is equal to announced accuracy, is equal to Q. So using this property and solving it, we get that Q, which is equal to FP, is equal to K minus X log of 1 minus P. So now we have also gathered the equation which actually tells us what the expert's announced accuracy is. Okay, expert whose competency is 0.5 will be known to be the worst type. So there is no incentive in being overconfident. So his announced accuracy will be Q.5. We can use this to find FP. So we have shown that in the next page. So we have assumed that it's a worst type. So worst type, then P is equal to 0.5. Q is also equal to 0.5. We get K. Now, if P is greater than 0.5, now we try to calculate FP over here, and using the same K function that we have found over here, we plug in the values and we get FP is equal to 0.5 minus X log 2 times 1 minus P. Now this is for P, which is less than P star but greater than 0.5. So now we are saying that Q, announced accuracy, is equal to FP, which is this function. Then if P is greater than 0.5, then we see that Q is greater than P. Okay, so if P is greater than 0.5, then announced accuracy is going to be greater than the expert's competency. This means higher announced accuracy indicates higher competency. So because high announced accuracy means high competency, even incompetent experts will announce higher accuracy. The reason is because they want the people to believe, or the market believe, they're competent. Competent experts, because of above, will announce higher accuracy even from the previous one, because it is less costly for them to be wrong, as he is more likely to be right. Because of the cost function, he's likely to be right, so he can take on more risk and announce even with higher accuracy. So, and announced accuracy can be even higher. This creates an upper bound for being accurate, and it is difficult to find who is more competent than the other at higher announced accuracy. So ultimately we reach an upper bound where everyone is accurate, and it's or they belong to the same accuracy grouping, and it's difficult to find which is accurate in the other. So therefore we can see if if Goldman is more accurate, or JP Morgan, which are more highly competent companies.